Hello, I'm Donald Leggatt from London South East, and today's CEO interview is Hayden Locke, CEO of Emmerson, who are developing a low-cost, high-margin potash mine in Northern Morocco. Welcome, Hayden.
Thanks, Donald.
Now, we've been waiting for the feasibility study to be completed for what, 18 months or so? Is this the world-class potash mine you've been promising us?
Yeah, we think from our perspective, it absolutely is. It's improved, if anything, on the scoping study, which is very unusual for a project moving from, the scoping study level of engineering to the much higher engineering categories that are typically associated with a feasibility study.
Why do you think you've actually managed to do it better than your scoping study? It's very unusual.
Yeah, well, we included a fairly large contingency in our scoping study to account for, so the scoping study, you typically spend less time going into the devil. The devil is always in the detail. And to account for that, we stuck a much larger contingency than you probably would see from many peers. And we did that very specifically because we knew that there would be uncertainty. We knew that there would be things that we hadn't necessarily captured, and we didn't want to have this situation where we delivered a number to the market and then we were rowing back on it. And it's very pleasing.
Does not give you the dilemma that you may not have discovered every devil? Is there a hidden surprise?
Well, there's always the potential for hidden surprises, and so again, you still have a contingency in there to account for that. So we've still got $45 million of buffer in the feasibility study, which is at the high end of what a lot of other companies would provide, and that is to account for those uncertainties. But I think the level of detail and the level of work that we've done thus far in this feasibility study gives me a huge amount of confidence that we've covered off, the vast majority of items, and the differences will be fairly minor in the grand scheme of the project itself.
Okay, it still remains a pretty large project, $400 million. Now, that's a big number, particularly in the midst of a global pandemic. Is the project still viable?
Well, the project is definitely still viable. So if you look at the economics, they're just exceptional, absolutely world class. As we regularly have said, we thought that this project was going to be. We're talking EBITDA margins well north of 60%, post-tax cash margins approaching 50%. Those are nothing short of outstanding. So the project is still economically viable. The big question is, where does the financing come to build a mine like this, and how much of an impact has coronavirus had on that? And I think the answer to that question will come out of the next phase of discussions, for which this feasibility study is the catalyst.
Okay, over what time frame will those discussions be taking place?
Well, we've already started a lot of those discussions, so we have regularly been updating with the various groups that could potentially be involved in this, and those range from debt financiers, straight debt financing, through to strategic partners, to bigger, just traditional financing equity partners, to non-traditional sources of capital. So the discussions have been going on for a long while, but really the catalyst to start getting serious about things is this piece of work that we've just put out today.
Okay, so can we talk to you about strategic partnerships? Over the year or two we've been talking, you've mentioned many of them. Are the Canadians a little bit more hard hit? Are the Chinese a little bit more bullish at the moment? Where do you think the interest is coming from? You've got Moroccan interest. Talk us through the potential strategic partners.
Yeah, so I think you're right. The Canadians are probably going to be a little bit more challenged, and given that they have invested a lot of money through the last cycle in expanding their brownfields capacity, they probably don't see any need to then go out and invest in any new projects, no matter how good those projects are. But I think also the coronavirus pandemic will probably limit their ability to go out and do any large new investments in the space. So I think the Canadians are very much not a focus for us. You're right, we're focusing on groups that have a need to own a source of potash. So they're fertiliser industry participants, and really the focal point for us is groups that are in that Middle Eastern region and in Africa. And there are a number of groups that have very large fertiliser companies there that need a source of potash in order to be a truly globally competitive NPK producer of multi-nutrient fertilisers.
So are you at the long list stage, or do you actually have a short list lined up?
Well, we're definitely well past the long list, because we've already started engaging with various parties and having early stage discussions. So I think we're well past the who's who in the global market, and much more focused now on who do we really think could potentially be a long-term partner for us as a company.
Okay. Today is feasibility study day. Do you expect your phone to be ringing from now onwards?
Well, no change, because obviously I've already had a lot of engagement with various parties. I'm sure there'll be some additional interest coming from parties that we haven't necessarily had high on our list or thought of previously, and we're open to all of those discussions. We'll be running every single potential opportunity in parallel to assess what's best for our shareholders.
Okay, a lot of parallel process. What about debt financing? You announced a debt financing deal quite some time ago. You're the parameters of one. Where are you with that?
So we've spoken to the same group who said that they're very happy to refresh all of those indications once we've finished the feasibility study. So having finished the feasibility study, we just need to put it into a model that's in the format that they can use. But there are a lot of alternative debt financing options available to a company like us. And there are a lot of new debt funds that have come out focused on the mining industry that have a real interest in industrial minerals and in particular potash. So we'll be running a formal process around that to assess all of those opportunities and again, understand which one fits best with our overall development strategy.
I've been reading in the Financial Times that the multinationals who are building war chests at the moment are actually getting lower interest rates, lower debt deals, better debt deals than they've ever had before. Where would you fit as a smaller AIM-listed company?
So we're not going to get anywhere near the amazing terms that a big corporate's getting that has a lot of history, a track record of financing. But the benefit of a low interest rate environment is certainly passed through, at least to a certain extent, to us. So we'd expect to be financing certainly sub 10%, probably closer to 5%. There are all sorts of reasons why it might be a little higher or a little lower than that, but that's our sort of target range. I think the good thing about this project is even if we were financing at 10%, it would be more than capable of taking that finance. And so there are some other softer issues that you take into account rather than just the headline cost of debt.
Does COVID make it better, worse?
Well, look, I think in terms of project execution, it makes it more difficult if we remain in a lockdown environment. Obviously, it's going to be very difficult to mobilise 1,000+ people to a site in Morocco if we're still in lockdown. In terms of financing, look, I think there's still quite a lot of money sitting on the sidelines, notwithstanding the fact that a lot of big companies have drawn down on revolvers. There's certainly money available for good projects, and the world needs to carry on. So we've just got to go out and really find out who has the capability and the desire to invest in new projects and focus our attention on them.
Okay, let's turn to the detail of the feasibility study against the original scoping study. Operating costs are up, estimated production has come down. Should I be worried? Does this mean Khemisset isn't quite the world-class asset that you promised us?
Well, the operating costs have gone up a little bit, as you say. I think as a general rule, what you see going from a scoping study to a feasibility study and just the extra level of detail that I was referring to is typically very large movements in those costs. So we're very, very pleased with what is much less than a 5% change in our operating cost delivered to our target markets. It still puts us right firmly in the bottom quartile of delivered costs to our customers. So we're very comfortable about where we're sitting on the cost curve and our ability to be competitive regardless of those sorts of costs. In terms of the production, you note we put out an updated resource for which the grade came down. Tonnes went up. So the reduction in production is mainly around a reduction in the grade going to the mill. And we've just kept the production rate the same as what we did for the scoping study to keep it at a manageable size.
The grade wasn't great. So is it worrying that it's come down slightly?
I don't think it's worrying. It's typically a fact of life when you drill out deposits to a higher degree of confidence that the grade comes down. It's very rare to see a project with an inferred resource then be drilled and the grade go up. It has happened. It happened to me once with a gold project, but it's very, very rare. The amount that the grade came down sub 10% is actually pretty pleasing considering how much more information we have. And I think one of the things we know about this project is we have a huge amount of drilling data. Really, the grade went down mostly as a result of us lowering the cutoff grade to pull in more resource into the project, rather than any sort of issues occurring around the grade of the deposit itself.
Looking at the feasibility study, you've opted for slightly higher potash prices than they are currently. Now, if you were slightly less generous to yourself and actually used current prices, would the project still look quite as feasible?
Yeah, you're absolutely right. We used the same price assumption as we used in the scoping study, and we did that very specifically so that people would be able to compare apples to apples, the scoping study against the feasibility study, because, as I've said, I think to you previously, predicting what's going to happen in the future for prices of any commodities is a mug's game. And so what we do is just set a point in the sand where we have a pricing assumption and see what the economics look like that. What's really important is to run the sensitivities at low side and at high side to get a view of the ranges. And I think what's really pleasing is if we run the absolute downside scenario, the worst price that we've seen in Brazil for the last 15 years, so quite significantly lower than where we are today, this project will still have a 15% IRR and deliver nearly $90 million a year of post-tax free cash and deliver over $130 million of EBITDA.
So the economics are decent, even if you have a really disastrous commodity price.
Correct. And the most important thing is the prices will never stay at that level for very long. And the reason for that is at that price, about 30% of global supply is either just break even or underwater. And what you see in the potash market is a very strong supply response when you get to that level. And so realistically, what have we got to do as a business when the price gets to there? We've just got to survive. We've just got to survive and be able to pay our debt and not blow up the company, because eventually the cycle will return and we'll be back making a very healthy return.
Your mine life has been reduced by a year. Should I be worried about that, or is there still lots of exploration potential to come?
Well, we've only included 40% of the total mineral resource in the study.
Your JORC resource?
Correct. So our JORC resource is about 530 million tonnes, of which we've included about 200 million tonnes in the mine plan for this. It's a lot of work to bring resource into a mine plan, and so for a variety of reasons, we just decided to keep it at the 200 million that we used. So we will certainly be able to bring at least some of that into the mine plan at a later date. That would suggest we could certainly go close to doubling our mine life, all else being equal. In terms of the reason that the current mine life went down a little, it's primarily down to more information on the feasibility study. So we did a lot of geotechnical testing on the cores that we drilled, which is an important parameter when designing your underground mine. And it wasn't as favourable as we assumed in the scoping study. And so there was a need to reduce the amount that we extracted to maintain that geotechnical stability underground. In the end, it didn't have that big an impact on our mine life. It did have an impact on our operating costs, but all of that is captured in the feasibility study, and still the project stacks up.
And you're not worried about that?
No, I think we've erred on the side of caution. We've been quite conservative with the way we've approached that geotech. So if anything, I see some potential upside as we go into more detailed design and engineering, and when we get underground, I think there'll be certainly some areas where we can improve.
Okay, there's a line in your RNS about metallurgical recoveries improving. First of all, what are metallurgical recoveries, and how's that been achieved?
Metallurgical recovery just is the term used to describe taking an ore, which includes all of the gangue material, the waste material that you don't want, and the precious commodity that you do, and how much of that precious commodity as a function of the total amount that's in each tonne you actually get out the back end. So our recoveries have improved from about 83 to 85%. That's mainly improved on the back of the detailed metallurgical test work program that we did, I think it was last year, at the start of last year in Saskatchewan in Canada, where we really went in and did an analytical process, for a variety of different ore compositions. What's been really interesting and quite surprising, actually, sometimes you have negative surprises, sometimes you have positive surprises. What's been very positively surprising here is we've been able to simplify the process based on that the data from that metallurgical test work program. And what we found, which was surprising to our engineers, is the ore that we have, which is a mixed ore of silverite, carnallite and ribbonite, when they're processed together, the chemistry actually causes the recoveries to go up. which was a very interesting and pleasant surprise for us. So all of the data showed that we will see improved recoveries by processing those ores together.
Talking of pleasant surprises, I see that selling salt as a byproduct is in the feasibility study. Now, we talked about this a while back. How much can you earn annually from selling the salt on, and is it not potentially a bit of a distraction from the main game, which is digging potash?
No, I don't think it has the potential to be a distraction, because it is really an identical product in terms of handling characteristics, in terms of shipping, in terms of export, in terms of all of those things. The main difference is just the price and what it's used for. What we had always known that we were going to produce a significant amount of salt that could potentially be used for a variety of different reasons. What we hadn't appreciated was just how easy it was going to be to get the salt that we will produce and get a stream of that is already of the required quality to be used in a de-icing salt capacity in the US. And it showed that it's a very profitable small business for, as a side business for the larger potash business. Now, it doesn't work without the potash because it's effectively free at the front gate. So that makes a huge amount of difference when you're delivering it. But it's certainly something that is based on spending, $23 million in CapEx for it, but returning close to $30 million a year of free cash. It makes a lot of sense from a business.
23 million is the cost, and then it pretty much within the first year it's washing its face in profitable.
Exactly. It has a better IRR than the potash project, but it doesn't work without the potash project. So you have to.
Right, but it doesn't work without the initial capex, indeed. Okay. So finally, big question. What are the next steps for Khemisset? Give me a sense of the news flow. Let's say for the next year. And will COVID get in the way of delivery? A big question for you.
The focus is going to be primarily on, first of all, permitting. So we have a great feasibility study, which we think is, addresses all of the key risks and areas that we need to focus on for the next phase of detailed design and engineering. But really the focus now is to get the mine and all of the associated permits in hand so that this project can be effectively shovel ready. And then the second prong of focus for me over the year is going to be really the remainder of the year. That's gone quite quickly, is going to be exclusively on finance and how do we find a strategic partner or other partner to help us fund the development of this project in the next phase, which is detailed design and engineering, and then into construction, hopefully, if everything goes well, sometime next year.
So you're going to put your finger on when construction might, in a perfect world, begin?
Well, it's all going to be predicated on can we get a financing package in place that allows us to do that. But assuming that we get something in place relatively quickly, I don't see any reason why we couldn't start that process next year.
Hayden Locke, let's end it there. Thank you so much for joining us as ever. For more interviews like this, please do subscribe to our London South East YouTube channel. And as always, stay safe.